Hello and welcome to this introduction to swaps, brought to you by Passing Score, where you can get more help on your exam prep at PassingScoreFinance.com. In this video, we'll be going over the definition, an example, and show you some different types of swaps. First, let's start with the definition. A swap is a contract for the exchange of one set of cash flows for another set of future cash flows. So if you are a fixed payer for some stream in the future and you want to switch to variable, you can find somebody to trade places with basically. So they become fixed and you become a variable payer. Now, why would you want to do something like that? Well, one reason is to convert or hedge your financial exposure. Let's say that you have a large variable interest rate obligation, but your income is fixed somehow. You can convert that fixed income into a variable income, which better matches your obligation and reduces your overall risk exposure. And there's a lot of different scenarios in which swaps can be used to hedge your position. Secondly, there's the idea of a comparative advantage. If you can borrow very cheaply in one currency, but you need the funds available in a different currency, you can go ahead and borrow in that first currency and then swap that with somebody that can borrow very cheaply in the currency that you need. And in that way, both of you can have a lower interest rate than you could get individually. And finally, you can speculate on interest rates, currencies, or other assets using a swap. Let's take a look at the structure of a plain vanilla interest rate swap. Let's say that you've graduated from college with a finance degree from a very good school, but unfortunately, you've had to take on just a hair of debt. You have a $1 million student loan at a 5% fixed interest rate. Now, that $1 million, we're going to use that as our notional or underlying asset. This is the basis of which we're going to calculate changes in the value of our swap. And these terms, notional and underlying asset, are used for other derivatives as well. In any case, we have a $50,000 fixed interest payment to make. Now, being a finance major, you take a look at the markets and yield curves, and you decide that for your situation, a variable interest rate would serve your needs better. So you go out and find a swap counterparty, and this could be a bank, a hedge fund, or maybe just an English major who doesn't know any better. So in any case, you make a deal with them to pay them a variable interest rate of LIBOR plus 250 basis points in exchange for receiving the 5% fixed rate, which will offset your student loan payments. Now, this may seem like a good deal if you start off with a $35,000 payment, which is saving you $15,000 in that first year. But what you've also done is take on an enormous risk. If LIBOR shoots up over the next year, you may end up paying much more over the life of the swap than you would have during the fixed rate initial loan that you had. But the important thing is that you're able to use the swap to convert your position. You started with a fixed 5%, $50,000 fixed payment, and you were able to convert that with a swap contract to a variable LIBOR plus 250 basis points with a variable payment. Let's take a look at another example with a commodity swap. And this is a hedging example where we're a factory that uses 1,000 barrels of oil per year. And what we've been doing is buying that oil on the open market at the spot price. So we've been subject to the volatility and oftentimes upward movement of the market. So what we want to do is introduce some stability, some certainty into our input prices so we can plan better and hedge against maybe sharp rises in the market price of oil. So we can enter into a commodity swap in which we agree to buy oil at $80 a barrel for 1,000 barrels for the next few years. And this is going to be a financial settlement. So we're just going to pay or receive the dollar difference between the spot price and this $80 a barrel price that we've locked in our swap contract. So we continue to buy oil on the market, but we're going to be offsetting that with our swap contract. And there's a difference between financial and physical settlement. A physical settlement, which would mean that we would accept actual deliveries of oil. So we don't necessarily want that. We just want to settle financially and just buy our oil on the market. Let's take a look at how this example works in terms of the dollars. If the spot or market price shoots up to $100 a barrel, our swap settlement will pay us $20,000. We'll receive $20,000. Now, we'll go out in the market and pay $100 a barrel, but we're going to offset that with the $20 a barrel that we're going to receive so that we're still paying $80 a barrel for our oil. If the market or spot price goes down to $60 a barrel, we're going to end up paying on the swap settlement. So we'll end up paying $20,000 in total. And when we go out to the market, we're going to pay $60,000 for our annual 1,000 barrels of oil. So that our net price is still $80 a barrel. We haven't changed at all because we've locked in that price with our swap. So this is reduced the risk of volatility in our planning, in our business planning, and in our profits and everything that we're doing, and protecting us against not just sharp rises, but any change in the price of the oil. Now, you might be wondering, how do you value a derivative like this? Well, initially, all swaps start with a zero market value at initiation. So the first day, they have a zero market value. We make sure to adjust, and in this example, the variable interest side so that it equals the market value of the fixed. So we start with a zero, but immediately after, the very next day, the swap will never return to a zero market value again. And the way we calculate that value is taking the present value of one side, one leg of the swap, and taking the difference between that and the present value of the other side, or let's say the variable leg of the swap. And the net of these two will be some difference which will equal the market value of the swap. The changes that cause it to move from a zero are changes in the market price, which happen all the time, the changes in interest rates, and just the time value of the after the initial setup of the swap. Now, as you can imagine, there's a lot of different ways you can structure a swap, not just with currencies and commodities, but there's also total return swaps, things called swaptions and trigger swaps, and these we'll get into in a future lesson. Well, that's it for our introduction to swaps. If you have any questions, please feel free to email me at john@passingscorefinance.com, and thanks for listening.